Hey everyone, welcome to another Friday weekly chat. Today we're going to be talking about the Fed meeting on Wednesday. I'm sure you've heard a ton about it. And this one was even more interesting because in light of all the banking issues that we were having recently. We wanted to kind of see what the Fed would do. A lot of people thought kind of when the banking crisis hit a week and a half ago that the Fed was probably going to pause with rates, but then as things got closer and the Fed funds future prediction rate kind of had about an 85 to 90% that they would indeed raise rates another 25 basis points, which is in fact what they did. So it's kind of wanted to go over what the statement was, what the outlook is, what we think may be happening, and more importantly, the effect it has on our investments and portfolios. So let's kind of jump into it now. The Federal Reserve approved another quarter percentage point interest rate increase, but signaled that banking system turmoil might end its rate rise campaign sooner than seemed likely 2 weeks ago. The decision Wednesday marked the Fed's ninth consecutive rate increase, aimed at battling inflation over the past year. It will bring its benchmark federal funds rate to a range between 4.75 and 5%, the highest level since September of 2007. Fed Chair Jerome Powell said officials had considered skipping a rate hike after banking stress intensified last week, and he also hinted that Wednesday's increase could be their last one for now. Depending on the next extent any lending pullback that follows a bank run earlier this month, new projections showed almost all 18 officials who participated in the meeting expect the Fed funds rate to rise at least 5.1%, implying one more quarter point increase and no rate cuts this year. So what does that essentially mean for our portfolios? Well, policymakers also softened their language on further rate increases. After January's meeting, the statement said that the rate-setting committee anticipated ongoing increases in rates would be appropriate. Wednesday's statement said that some additional policy firming may be appropriate. The devil's all in the details. So that one little change kind of had the market on Wednesday kind of seesawed, where it was down, then it went up, then it kind of went down. Market yesterday closed, it was up big and then kind of closed flat. And today on Friday, the market is, kind of down a little bit. So what does this mean? Well, essentially what this means is, and if you look at the Fed funds rate chart, we kind of anticipate another quarter percentage rate increase getting us to about 5.1%, and then over the next year and a half coming down. So this is the game that the Fed's playing. Right now they're trying to battle two sides. They're trying to hold off on a banking issue and banking crisis, and one way to do that would be not to raise rates, because then the yields on these bonds, the prices would be going up and yields would be coming down, which helps their balance sheet. But they also have inflation, so they kind of have two sides of the monster here. And inflation is still 6%, which is still about 4%, 3.5% higher than their target rate of around 2.5 to 2.8%. Again, as interest rates move in a positive or negative light, our investment accounts are going to move in a positive and negative light. Our stocks, if interest rates are coming down, yields on bonds are dropping, stocks are going to go up. And the same is going to happen in the bond market. So kind of the bond and stock market is kind of correlated the same. It has a positive correlation, where normally when stocks do good, bonds tend to do okay as well, but they don't always go hand in hand. Or more importantly, when stocks don't do as well, then bonds typically will help offset that. That's why we do asset allocation and have our model set up the way that we do. But and because you have a flight to safety, people are worried about stock prices, so they go to bonds, which is typically seen as more conservative. However, in this environment, that is not happening because it's all about interest rates. As we've had this historic rate increase, in my opinion, the Fed has mismanaged it, which has caused a bond bubble. It's caused an asset bubble in the bond world, which we went over that last week as to why that kind of caused, the banking issues that we had. So just having said that, the investments is, with this next Fed rate increase that we had on Wednesday, kind of same old, keep sticking with our strategy. So that's it for this week's weekly chat. Remember, get some pizza. See you later.